When a private company that everyone recognizes finally goes public with an IPO, it's suddenly everywhere. The headlines, the buzz, that feeling that this is the moment you cannot miss. But here's what most people do not see. By the time that offering prices hit the news, about 90% of those shares are already gone. They've been allocated to institutional investors during the roadshows. Individual investors, they get their shot once trading opens, not before. Since 1980, the average IPO has jumped 19% from its offering price to its first closing price across more than 9,000 deals. And that pop goes to whoever bought in early, not whoever buys at the open. And the company, it's not really a startup anymore. In 1980, the median IPO company had about $64 million in revenue. That's adjusted for today. And by 2024, that number was 218 million. That entire growth story has already happened in private markets before the public ever had a chance. Here's the part that should give you pause. Research from the University of Florida found retail investors who buy into IPOs underperformed by roughly 20 percentage points in the first year alone. And 56% of IPOs bought at the offer price were still down after 3 years. The companies that generate the most excitement are often the ones that disappoint the most. None of this makes an IPO a bad investment. It just means that you're buying in at a different stage than what the story suggests. So before excitement turns into a position, it helps to ask what you're actually buying and why. If you have questions about how a new opportunity like this fits in your overall strategy, we are happy to walk you through it.